What's up, everybody? Welcome aboard. Glad to have you for another class. Bubba here, and hope you guys had a great weekend. Hope you enjoyed the homecoming victory. Always nice to start the week off with a victory. And this week I thought we'd talk about something a little different and something that can help you become a better investor, trader, and kind of learn what we're looking for when we are trading. And we saw, obviously, the markets got crippled, as you're all too young to remember, but in 1973, Joe Frazier fought George Foreman, and the famous tape was "Down Goes Frazier." That was from Howard Cosell, which I think he was dead by the time most of you were born. But anyways, down come the markets, and if you've been watching and learning the technical analysis from Mr. Navickas, you will see that there hasn't been, fundamentally, we have not seen a lot of change in the market. We know that there is a tremendous amount of troubles throughout the economic area. We know that there's worldwide problems. We know that every economy in the world is struggling right now, and we've seen a lot of strength in the U.S. dollar. We've seen a lot of strength in the U.S. Treasury bonds, which does indicate that there is some fear in the world. So what we're finally seeing after all this time is the free money Fed, which one day I'll come and explain to you what that is all about. But the free money Fed has finally given up, and the traders, excuse me, and traders are not so apt to want to jump in and buy anymore. For about the last 3 years, every time the market made a dip, let me just switch back to charts for a minute. Every time the market made a dip, traders would rush in and investors would rush in and they would buy. So if we look at a longer term chart here, let's go to 3 years, we can see that every time the market dipped, we saw buyers. We saw buyers. And now we don't see buyers so quickly coming back in here. Now, the key level that we'll be looking for here is probably 16,400 in the Dow, but a better gauge of the economy and a better gauge of markets is the S&P, because that, if you remember, the Dow only represents 30 stocks, where the S&P represents 500. So if we look at the S&P, we can see that did actually come down to a very key level on Friday, and I wouldn't be surprised to see a bounce here. I think we're going to be looking as traders to sell rallies. If you're an investor and you have a little extra money, you can invest here. I mean, again, investing is a whole different animal, and someday I'll come and explain that as well. But as far as trading, you could possibly look for a little bit of a bounce here. But what we are seeing, and this would be very troubling as an investor and a trader alike, is what's going on in the Russell. As we see the Russell for years had the same problem. Then it got into this big consolidation pattern, which is really huge and unusual to have a consolidation pattern of 10%. But we had a 10% up and down move, a 10% up and down move, and now we've actually broken more, and we're now down in the Russell about 13% from the high and looking to go lower. Now this is very ugly. So if I look at the counter indicators of the market, I would say that if the Russell would rally back up to 1075, that would be an area that I would like to be a potential seller. Now, the reason I like the Russell the best as a gauge, I actually like the Russell and the NASDAQ, but the reason that those two indexes I find is a much better gauge, and this is an important lesson to learn, so pay attention. I know you're tired, but pay attention. The Dow and the S&P are filled with mostly safer stocks. Coca-Cola, Apple, you name it, ExxonMobil, any major company that you can think about, goods you use, Johnson & Johnson, Pfizer drugs, all those, that's what those indexes are filled with, relatively safe stocks that aren't going to have major up moves or major down moves. They will typically be steady. And big-time investors or big-time funds that have to always be invested, when they're afraid and they're scared of the market, they are investing in the S&P and the Dow, because those are what they consider to be the safer, bigger capitalized, more money stocks. Now, when risk is on the table, we are typically looking at the Russell and the NASDAQ. NASDAQ because it's a tech-heavy index, and technology can really drive markets crazy back and forth, and the stocks have a much better chance to move. If you would take the average S&P stock versus the average NASDAQ stock over the last year, if the average S&P stock was, let's say, up 5%, the average NASDAQ stock might have been up 20%. And if you go to the real risk, which is the Russell, which is what we're looking at now, Russell stocks, they are what they are, small cap stocks, which means they are undercapitalized, but they have a lot less capital to deal with. They're much smaller, they're much more easily manipulated, and they typically trade more, but a stock in the Russell. So if we go back to the ratio of 5% S&P, 20% NASDAQ, it might be 50% in the Russell. But the Russell is the index that really tells us where risk is and the risk appetite of the market. And right now it's telling you that the market has no appetite for risk. And then we can combine that in with the VIX. Now the VIX is the overall volatility gauge on the overall market. So the volatility gauge in the market, we like to compare it to air going in and out of a balloon. So volatility is rising here, but you can see based on this chart, we are nowhere near full capacity of volatility, which indicates to us that the markets still have some work to do on the downside, because rising volatility will typically indicate and drive us to find a market that is going to go lower. Okay, rising volatility is significant in understanding that a market probably wants to go lower. So, but one of the key things if you're a more active trader and you want to be more active, what you do is you actually watch volatility. And if you see volatility falling in a falling market, that would typically indicate a market that was reaching a temporary bottom. If you see volatility rising in a rising market, that would be an indication that the market was reaching a peak and probably was going to sell off. So if you remember those things, the VIX and the markets in general should go in opposite directions. Okay, again, those two markets should go in opposite directions. If they are going the same way, follow the pattern of the VIX. The VIX is a more accurate indicator of what the market is going to do, because the VIX is designed to gauge the number of puts and calls being traded. So when the VIX is rising, that indicates that more puts are being bought, which indicates that there's more bearish sentiment on the street, which means that the market most likely is reaching a level. This is very important in your overall trading. Now, as an investor, you're not concerned, but as a trader, these are little trigger points, and these are one of the footprints we use to look at when we're trading the market. Okay, so it's all about the first things we look at as we gauge market conditions is what is the risk appetite of the street. And when the Russell and NASDAQ are falling faster than the rest of the markets, that means that the risk appetite is wearing out. Also, if you look at the Treasury bonds and the strength of the US dollar, that is also an indication of a market that is a little bit on edge and a little bit afraid, which means that we don't look to see it going much higher. So what I'd like to see you do during the week is try to watch this, during class or on your own, and kind of find out when we see rising volatility versus falling volatility and how the market reacts. Because just if I can pop this up real quick, and I don't know if I can get to it, but I'm going to try. If we go back on an hourly chart, we're going to go back. Now, a week ago Thursday, okay, so about 12 days ago or so, we had a market that was making lows. Okay, now this is switch charts here real quick. This is very important. I actually called this live on TV while it was happening. Okay, we saw the market was tumbling. Okay, on the Thursday, and this was making low after low. It was just getting creamed. Okay, so we can see the date was 10:30 in the morning our time on Thursday, the 25th of September. So now if we go back and look at the VIX, okay, and let's scroll down to the VIX if I can find it. Okay, and we scroll down to the VIX, and we go back to Thursday, the 25th, okay, the VIX at the same time was starting to fall, okay? That was an indication that the bottoms, temporary bottoms, might have been in, and it gives us an indication of if we can find a good chart point to enter, we might have entered. Anyways, everybody, have a great day. Thank you so much for your attention. I appreciate you, and we will be back with Bubba next week. Take care, everybody. Thank you.